All right, welcome in. This is the Cow Guy Close, and I'm Scott Shellady, also known as the Cow Guy, and I'm happy to be back in the saddle. I missed you a lot. We're traveling around as well. Talked to a lot of you too. Great times. We'll talk about that later as well. Let's get started though with this though. Yesterday was a doozy, right? Depending on your news outlet of choice, and the reasons for the move lower in equity prices, they were varied. The excuse du jour was Trump's tariff retaliation after the Supreme Court denied him of some of his initial tariff moves. And a 15% tariff was instituted across the board as a basic placeholder until a more coherent trade policy could be put in order. But you know what? The real reason was the sell-off was, in my eyes, came on the heels of research that was penned by Citrini Research. Yeah, I've never heard of them either. Citrini, who are they? But suffice it to say, they didn't paint a pretty picture for our economy when AI is fully instituted, right? The report mentioned a big disruption to the global economy. Things like recession and stock crash were in the research as well. My next guest knows what I'm talking about, and he's been a bit of a guru lately for getting out of some of those tech trades. Let's bring him on the show to talk about more of his thoughts. Bring him on, Mr. Eddie Ghabour, coming to us from Key Advisors in Lewis, Delaware. Thanks for being on.
Thank you,
Eddie. I appreciate. Yeah, we're just talking off air. I have so much on my mind to talk about, but you've nailed these last moves. We continue to see the market. Kind of its psychology has changed. It's not looking for reasons to sell off, not looking for reasons to rally, and especially when it comes to the tech sector. And yesterday, everybody wanted to talk about tariffs, but I don't think that was the case. I do think it was that research by Citrini. I have no idea who they are. I don't know if you've maybe heard of them before, but they painted a pretty bleak picture when AI would be fully instituted across the space. And I think the market really got spooked on that. What say you?
I think right now, we humbly say we expected at least a 20% sell-off in technology coming into this year, which is why we rotated out of that trade for the most part. I think it's more of a story of the fact that their earnings peaked at last year, and coming into 2026, the bar was set too high. And there's some concerns with some of the CapEx spending numbers coming down. There's also some concerns with credit being available for all of the infrastructure builds. So I'm looking at this as just a normal recalibration of a sector that's had an amazing run, and it's just time for it to correct. So there will be buying opportunities in tech, in our opinion, sometime late second quarter, early third quarter. So it's not a doomsday scenario like some of these research firms are trying to paint. But again, I think you're going to see a bigger sell-off accelerate in the second quarter just due to that. And lastly, I'll say, I know investors are really consumed with the tech trade. There's a lot of other areas that are working right now. So, we're not concerned with the tech not working because there's other areas that are. And that's what we're focusing on, is where the bull markets are and getting out of bear markets. And there'll be a time to rotate back in, but it's a little too early in our opinion.
Okay, so, I can't now ask you what you think those areas are because, again, I've been on the road. I spoke to a lot of the folks that watch this show. They love you, by the way, and they want to know, hey, if I'm not putting my money in a big tech, where am I putting it?
I think you can, I use a term right now that boring is good in portfolios right now. And when you look at things like industrials, home builders, things that are more economically sensitive, even though there's a debate on the strength of the economy, I trust what the market is telling us. And the market is telling us that economic growth is going to accelerate over the next few months. And so this is why these areas continue to have strength, much stronger than technology. When you look at the difference in returns from those areas and where technology is, there's actually an argument that things have really broadened out. And you look at the tape today, even with this big move, there are some software names that are still red. And that to me speaks volumes, where when you're looking at small caps and industrials and home builders, they continue to rally. And so those are the areas we're focusing on. And frankly, right now, I don't think having a little bit of cash in a portfolio is a bad thing, because I think you want to set yourself up for the next potential move, which would be buying some big losers in the late second and early third quarter.
We were off air and we both spoke about, hey, you saw Microsoft go from $500 a share to under $400 a share. That's big, significant. And then obviously we both mentioned IBM coming off as well. That got hammered. So some big names that are pretty household names are really kind of taken out on the chin as investors are looking, I guess, elsewhere to put their money. But I have to say this, okay? I'm a techie. At least I enjoy technology. And over the weekend, I had a little time, and so I went down a rabbit hole, as one does. And, let's just say that there's 8.1 billion people on the planet right now. 84% of the people on the planet have not touched AI yet. They have not had any interactions with it. They haven't used it. I mean, that means only 16% of the world has done it. And the folks that have touched it mostly, they're writing emails or, thank you notes with AI. They're not, or, using it as Google. It's still really in its early inception days. However, the market is now psychologically changed to worrying about the spend. And if there's anything in your report that might be negative, they're going to pick that out instead of anything that's positive, like we used to do the last few years. Would you agree with that?
I do, and this is why I say right now as an investor, it is critical to be patient and not try to catch a falling knife in this area, because it doesn't matter what we think fundamentally, because I agree fundamentally we are very early innings of AI. But as I say, the market doesn't care what I think fundamentally. The market will speak in regards to whether it's a bullish market or not. And right now, the market's telling you to be very cautious in the technology space. But I think there's going to be a tremendous amount of wealth that can be made if you buy this right. And this is why, again, I would be patient here, because what AI is going to do is productivity is going to boom. Profits are going to boom, but it's very disruptive. And when you have a disruptive technology, there will be disconnects and time periods in the market where you just have to sell and wait and see what happens. And that's where we are right now, in our opinion.
Well, you've nailed it as of late. I got to give you a chance to take a little bit of an attaboy pat on the back and two around the shoulders of the room on everybody's shoulders. But I will also say this, and I heard an old trader tell me this at the New York Stock Exchange when I was a young man, but he'd always say, it's all about timing, said the rain dance man. And I think that makes pretty good sense right now. And we'll leave it on that one. I appreciate you coming on, Eddie. Eddie Ghabour coming to us from Lewis, Delaware. He's with the Key Advisors Wealth Management, co-founder there. Appreciate you coming on. See you again next week, brother. Don't go anywhere.